Joining me right now is former Federal Reserve Chairman Alan Greenspan, who served 5 terms as chairman of the Fed. It is good to see you, sir. Thanks so much for joining us this morning.
It's my pleasure, Maria.
Let me ask you about your take on inflation and how this economy feels to you right now. We have seen a better GDP, right, Dr. Greenspan? We've seen, obviously, better jobs numbers. Do you see the indications of inflation this morning?
They're not immediate, and in fact, until inflation rears its head politically, we're not apt to do what is required to sustain the process, which is now beginning, but is unlikely to show in the data for still quite a while. We're in a state, we have been in the state of stagnation for quite a number of years, since 2008, in fact. What we're looking at now is the merging to what we used to call stagflation, which is the combination of slowed economic growth and accelerating inflation, which theoretically was not supposed to be able to happen before. But we're moving towards stagflation, and in the process of moving in that direction, it feels good, but it's a false dawn.
So tell us about that, because there is a feeling that things are going to slow down quite a bit going into 2019 and 2020, Dr. Greenspan. What are you seeing? I mean, look, the last GDP number we got was showing 2.3% growth for the first quarter. Do you agree that things are poised to slow down, economically speaking, in terms of growth in the coming years?
Well, they're already slowing down, although you've got to be careful with the first quarter number. As everyone has been complaining for a long period of time, the seasonal adjustments for the first quarter tends to push the GDP growth rate down. But the critical issue is that the longer term does not exhibit a particularly powerful GDP growth rate, and all of the major analysts who look at the data in the future, including CBO and the Fed and all others, see a slowdown quite significantly from where it's been at the 3 to 4% range for a goodly part of the post-World War II period.
Why is that, Dr. Greenspan? I mean, this fiscal stimulus that we've been talking about now for a year, and what I'm referring to, obviously, is the tax cut plan, the rollback in regulation, which really did move animal spirits a bit in terms of the business spending component of all of this. What is causing things to slow down?
Well, first of all, let me just say that the 2 major initiatives of this administration, namely the tax cut, the corporate tax cut specifically, and deregulation, have been very positive forces. And indeed, you're already beginning to see the impact of both of those initiatives in the marketplace. But when you look further down the road, the demographics are against us. The most productive people in the economy are retiring, and the basic structure of productivity growth is being suppressed by the huge increase in entitlements, which largely is not an economic phenomenon. It reflects the aging of the population and a number of other things which are in those data. But the main issue is Social Security, and Social Security is a significant problem in the sense that it is not being funded. The actuaries of the Social Security Administration, in fact, say, in sort of a hidden part of the last annual estimate, that in order to get an actuarially sound Social Security system, you have to cut benefits now and indefinitely into the future by 25%. What that is telling you was the fiscal system is out of whack, and while I approve wholeheartedly of the corporate tax cut and the deregulation, the corporate tax cut unquestionably causes the deficit to rise, and we're not funding it by other means. And so long as the funding is not there, productivity cannot grow and accelerate, because what you need is gross domestic savings. And the major component of that recently has been the so-called budget deficit or surplus,
yeah,
which effectively have major forces driving capital investment.
You are hitting on exactly what the story of the moment is right now. The fact that you've got these demographic changes causing this slowdown, and then we just had this huge omnibus spending bill, which of course has no plan in terms of reining in the entitlements. So we're talking about higher interest rates as well, complicating things because it's going to get more expensive to finance the debt. So these are the issues that are front and center right now, even though we're talking about a good reaction to that corporate tax cut plan.
Well, I think that if you look in sort of marginally into the future, we're no longer seeing the productivity growth that, remember, was 3.5% to 4%. Not that many years ago, annually.
Right.
We're now under 1%. And productivity growth is the key factor engendering gross domestic investment.
Yeah.
So you can't have the type of growth we had in the past if productivity is flat on its face.
Yeah, it's such an important point.
Growth, I should say.
Yeah, exactly. And that's why we're talking about a labor shortage, and we're talking about, CEOs not finding the workers that they need. By the way, I put all of this to Secretary Mnuchin this weekend, but he says he doesn't see a slowdown on the horizon. Listen to what he said, Dr. Greenspan.
Don't buy that at all. I think, again, we see very strong economic growth for the next several years. And in regards to the tax plan paying for itself, if we do get the economic growth, by definition, it will pay for itself. The difference between 2% and 3% GDP is trillions of dollars of revenue to the government.
He said he's looking at 3% growth for a couple of years out. And he said he's hoping we don't see $1 trillion deficits.
It'll be a very tough haul to get there. It's a demographic issue.
Yeah.
And so long as the entitlements continue to crowd out, remember what's happening is the big bulge over the years in entitlements is crowding out gross domestic savings.
Right.
Gross domestic savings plus savings borrowed from abroad is what our capital investment is all about. And we've already engendered $8 trillion in net debt to foreigners. These are trends which cannot continue.
Dr. Greenspan, let me switch gears. I don't want to not get to China before we run out of time. Do you think that this team in China is going to be able to move the needle on what we're talking about here? We all know the issues at hand in terms of theft of intellectual property. Chinese don't want to open up their markets. And, of course, that $375 billion trade deficit.
Well, remember that the trade deficit occurs because Americans want to buy cheap Chinese
That's true.
goods.
Yes.
And what a tariff would do is make them more expensive.